market was efficient,
they would have no opportunity.
if the efficient market hypothesis
was universally true.
They would actually, there would be no Berkshire Hathaway. We're Compound Everything, and we are here to talk about money and markets and all that stuff. And we're
on the road.
And we're on the road. We just finished yesterday the Berkshire Hathaway 2022 annual meeting.
Yep.
And so we thought that we would do a video in Nebraska while the meeting is still fresh on our minds.
Yep.
So what were our biggest takeaways? I think that's what we're going to do today. We're going to go through the questions and we're going to talk about what the biggest
takeaways from the meeting
were. So
one observation that we had when we pulled up to the meeting was that the meeting was much smaller than when we went in 2018. That was the last time we were here. So we pulled up to the meeting, and we've done this the 2 years we came. We pulled up very early in the morning,
10 to 5,
around 5 a.m.
We parked at 4:45, and we got on foot to the CHI Health building at 4:50 a.m.
Yeah, and we noticed there was substantially less line up there.
So the first,
even for that time.
Yeah. So the first year we went in 2018, there was already a good lineup.
Yeah.
Right.
Yeah.
But this time we went, I think we were maybe fifth in line.
Yeah.
At the door.
Yeah.
That we wanted to go in. And then when we got in, we were purposely taking note to see how fast things filled up so the doors. We line up at 10 to 5, and the doors to the convention center open at 7
a.m.
And then the meeting starts at 9 or something like that.
Yeah, something like that.
Yeah, so we were watching, and at 8:30, there were still fairly decent seats left. Not close. I think we were third row in the closest section. Yeah. We weren't on the floor, but there were still like decent seats left at about 8:30.
Yeah, but in 2018 when we came, that place was packed. It was full. So it was just a noticeable difference. That was the first impression I had.
Well, now is maybe the time to come because there's not
as much competition for seats.
Yeah, exactly. And it's just a little more relaxed. Yeah. Even the mall.
The mall area. So on the Sunday, the Borsheim's area was a little less busy.
Way less. Now that has to do with usually Bill Gates and Warren Buffett do a ping pong match, or they used to. That was like tradition or something like that. And they don't do that anymore. Yeah, so there's no point to go to see them. So, but... Anyways.
So anyway, first impressions. So let's talk about the meeting. My biggest takeaway from the meeting, I think, was just their emphasis on simplicity. So just the fact that one of the things that stuck out, rung in my mind, was Warren and Charlie were talking about business deal that they were going to go through. And so they said they had to get 2 fairness assessments to make sure that this was going to be a good deal for shareholders. I don't know if it was on either side of the deal. They didn't reference which deal it was. But one of the things that I can't remember if it was Warren or Charlie said, he said, Warren, Charlie, and this other CEO could sit down in a room for 10 minutes and figure out a fair value. But instead, they had to go through this kind of rigmarole to hire, I guess you call it investment bank, and pay them a lot of money in order to come up with 2 fairness opinions to make sure it was a good deal.
Right. And
he says, well, we don't need that. We can figure it out in 10 minutes, including the other CEO.
Right.
So I thought that just really stuck out to me, that they always say that their valuation process is simple. And that just kind of speaks to that.
Yeah. I think too, what was interesting is he did talk about the Allegheny.
Yeah.
And again, speaking to simplicity, right? He had been watching this company for 60 years, and then he got a phone call, and he was like, okay.
Right, yeah.
Right, or an email.
And he just went to lunch with that the one where we went to lunch with the CEO of Allegheny, and then he said, okay, let's do this deal.
Yeah, exactly.
He had a price in his head.
Yeah.
Beforehand, I think he had said he had a price in his head, and he had been following it for a long time.
Yeah.
And he said, I'll offer you this, and then he took it.
Yeah, the simplicity was
that was my key.
That was your key takeaway.
One of the takeaways for sure.
Another thing that you had mentioned was they kept talking about share buybacks.
That spoke to me too. So the example he used is American Express. And so they, I think he said 1997, took an 11% position
around that
in American Express. He said they haven't bought a share more since 1997, and what started as an 11% share in the company is now 20%. So they've upped their ownership just through American Express doing share buybacks. So that's a very powerful way to grow wealth in terms of increasing your ownership in a business.
Right.
That's very profitable.
Yeah.
Which
and I really liked, he really broke down share buybacks really well for people who might be starting in investing or who don't understand certain concepts. And he used the idea, and of course this resonates with us because we actually own farmland.
Yeah.
But he used the idea if you buy like 100, I can't remember his exact numbers,
acreages,
but let's say you buy 100 acres of farmland, and then after 10 years you have like 10 more acres, right, or 5 more acres, but you didn't do anything for it, just odd kind of magically appeared. And obviously that doesn't happen in farmland, but that's the share buybacks would be to farmland, is if you just got extra land for doing nothing. But it's a really good example for someone who might not fully understand why
share buybacks are important.
Not what a share buyback is, because I think a lot of people know what a share buyback is, but I think what they don't understand is exactly how it works and why it brings the shareholder so much value. And the other time he talked about it, that I noticed it was in your notes, was when he said Berkshire buys back its stock when everyone thinks it's a bad time. Right.
They think that they buy it back. By definition, they should be buying back stock when people think it's not the right time to buy back stock.
That's what they said. When people think it's not the right time, that's when they buy it back. And another interesting thing he said, and it was just in passing, was they don't always have a lot of stock to buy back, because people who buy Berkshire buy and hold.
Yes.
And he said they can't just come in and buy it because they got to buy it off of us. But the shareholders of Berkshire don't sell their stock
because they know it's good. Well, speaking along that line, it's precisely the opposite reason as to why they were able to take such a large position in Occidental Petroleum in so quick a time frame.
Right.
Is because people were just rifling shares back and forth for Occidental, and they managed to take, I can't remember how big the position was. They bought millions and millions of shares over a period of a few weeks, just because of the frantic trading that's gone on. With reference to that
which
security.
They mentioned a lot.
And they mentioned that a lot. And they said that actually worked out to their advantage to be able to buy it at such a reasonable price.
And I think they scooped up like 14%
of the company. I think they did. Yeah.
So back to simplicity. This goes back to, you said just the simple idea of investing was one of your main takeaways, how they keep it so simple. So back to Occidental, they said that, or I think it was Buffett, he said he read an analyst report on oil, and what the analyst said just made a lot of sense. Yeah,
it just made a lot of sense. And one of the things that I often think, and it's a misconception, is that the masters like him and Munger, don't read anyone else. But that's obviously false, right? They obviously take into account other people's thoughts in order to formulate their own opinion. And so
which is a sign of wisdom.
Which is a sign of wisdom. It reminds me of a Charles Spurgeon quote. This is one I love. It says something along the lines of, he who does not take the thoughts of other men's brains proves that he has none of his own.
Right.
So the point being is the wisest people out there are probably the most well-read.
Right.
And so they'll take someone's opinion and formulate their own opinion based upon that.
Exactly.
So that was something to take away as well, is that even a master investor like Warren Buffett or Charlie Munger will take the advice of others.
Right, for sure.
I thought that was interesting.
And then also on oil, one thing that I found super interesting was Munger gave his opinion on oil, which is he even said he's going to give his opinion, but no one's going to agree with it, but he's going to give it anyways.
Right.
And he said that he thinks it was crazy for the U.S. to get rid of some of their reserves, and it would have been better to pay the high prices, whatever it cost, from the Arabs, I think were his exact word, and keep their reserves, because he said that oil is such a precious and valuable asset or commodity that the U.S. should hold on to. Now, regardless of if you like that opinion or not, talking about gas prices.
Yeah.
I don't think that's so much the point. I think what I took from that is, I think we really have to step back and think, like, why did he say oil is one of the most valuable things that the U.S. has and they should not get rid of it? And that, because we are invested in oil, and we've been trimming, and I think he just is saying, like, there's no way we're getting off oil as fast as everyone thinks, and we still use it and we still need it, and it's valuable, and we're just kind of getting rid of it. And that was a super interesting side comment that he gave, and also it just speaks to why they bought Occidental, and I think they have a very large position in Chevron as well. So we've talked about the simplicity in investing that they have. We've talked about their position in oil. Are there any other we talk about share buybacks? That share buybacks was mentioned quite a few times.
That was emphasized several times. So another thing that they mentioned there, this is a bit of a funny story. They mentioned that, going back to the types of businesses they want to buy, they want to buy a business that's so easy, even someone with dementia could run it.
I think Warren and Ajit went to go see the manager in the story.
Yes, right? I think so.
Because I saw Ajit chuckling in his story.
Did you? I didn't catch that.
I saw Ajit chuckling.
But that's funny. So the point being is that
you may as well tell the backstory.
So I'll tell the backstory. So they, I guess, owned a business. I don't know if it was a part ownership or a full. It sounds like the latter. And they went to visit one of the managers, or Ajit went to visit
This was
one of the
after
managers.
lockdown, so no one had seen anyone for a while because everyone had kind of been locked down.
Yeah. And so the business was still doing okay, but I guess they went and visited the manager and noticed there was something maybe not quite right there. And then I guess in the end it was found that he was actually developing signs of significant dementia, but it was still running the company and managing the company. And so the company was still doing okay, though.
Yeah, the company was doing fine.
The company was doing fine.
Reason
no one had any clue.
They weren't going there to check because the company was suffering.
They're just doing checkup and see how the manager was doing. And I guess he wasn't doing okay, but the company was. So it speaks to the kind of business that they want to buy is one that's simple, and it would essentially run itself.
Dad, buy a company that any idiot can run, because one day an idiot will. But
Lynch.
Oh, maybe it was Lynch.
Doesn't matter.
But I guess now Buffett would say, buy a company that anyone with Alzheimer's can run, because maybe one day
one will. Exactly.
So
who knows?
That was good. Okay, so one of the things that I had in my notes is their comment, and it's almost a direct quote: they depend on mispriced businesses.
Yes.
And the word depend is because we kind of know that they are value investors and they need mispriced businesses. There's a lot to take away in that one sentence, but the one word that caught me was depend.
Oh yes, yeah.
They depend on it. In other words, if the market was efficient,
they would have no opportunity.
If the efficient market hypothesis
was universally
true, there would be no Berkshire Hathaway, because they said they depend on mispriced business.
Well, and that's like you were saying to me earlier in our private conversation, where you're saying you have to really dissect what they say, because they're saying something and they're saying it with intent.
Especially Buffett.
Right.
They
choose their words carefully.
He does.
Yeah.
And so they said they depend on mispriced businesses. So the two things I took out of that is that they depend on it. Mispriced businesses are the lifeblood of Berkshire Hathaway.
Yes.
They're dependent on that.
Yeah.
And they don't believe in efficient market hypothesis.
No.
Right? At least in the short term.
Yeah.
Because mispriced businesses happen.
Absolutely.
Hence the fantastic gains of Berkshire Hathaway. So that was an interesting, I don't know what they were talking about, but that one sentence, I wrote it down when they said it. It was pretty good.
Well, I was just going to say, with regards to another thought that came up, was the fact that they said, and I think this is not quite a direct quote, but I wrote it down. It says they haven't made any business purchase decisions or stock purchases based on any presuppositions of what the economy or the market is going to do. So he always says, and he's said this a number of times if you watch a number of their interviews, he says, I don't know what the market's going to do, a year from now, 6 months from now, or even 3 months from now, or even a week from now. They don't know what the market's going to do.
I think at one point he said, we don't know what the market's going to do on Monday.
They don't know what the market's going to do on Monday. Yeah, so the point being is they don't enter into a business decision looking at forecasts of market and economy, etc. Really, they don't they don't make individual business or stock decisions based on that. They just look at the business and the veracity of that business. Is it making money, and how much money is it making, and how much money do they estimate it's going to make in the future?
Yeah. So I'm going to jump ship here.
Oh, just getting out of the car?
Bye. No, I wanted to talk about just another point.
Yeah, go ahead.
So I really liked Greg Abel and
you said that a few times.
Yeah, they were up on the panel. I think that they should be given more opportunity to speak. But at the same time, I mean, Warren and Charlie aren't going to be around forever, so they have to get everything out they want to say.
And we want to get their wisdom.
But one question was about Progressive and Geico. So they own Geico.
Yeah.
Berkshire owns Geico.
And
a shareholder asked, I guess Progressive, and I can't speak to numbers because I haven't looked into it, but I guess Progressive is doing better fundamentally in some areas. And Ajit admitted that Progressive was in fact doing better, which right away made me so confident that he should be one of the successors of Buffett and
he's
Munger.
an able and trusted manager
because he's so honest. Because he said yes, Progressive. And then he told us why. So the reason was, is it called telematics? Telematics. And so telematics is just data collection on the individual who is being insured.
Right.
They use it a lot in cars.
So this car has significant we'll call it capabilities to monitor what the driver is doing.
So Geico has kind of dropped the ball in that area, and Progressive, according to Ajit, who is like the head guy at Berkshire for
their insurance,
so he knows what he's talking about. So he said Progressive just was ahead of them in telematics, and that is what made the difference in the fundamentals. But he also said Geico is working on it, and he's fully confident that they're going to be better. I don't think he said better, but he was kind of hinting towards that. And so it was just interesting that you have this company Geico who dropped the ball, but they have a management that understands why. Which also gave me a good glimpse of what type of manager he is. So he knows why. He admitted that Progressive was doing better at this point. He identified the problem, and he's working towards the change. So, I mean, telematics is an interesting topic all around. We love it. We think it's interesting. But when he brought that up, it really...
Well, that speaks to another point, that even an industry as boring and predictable as insurance can change.
Right. It wasn't a huge takeaway so much, but it was a question that made me appreciate and respect the fact that Ajit Jain was up on the panel, and I can see why Buffett and Munger. He embodies the culture that is Berkshire. And you saw it in that one answer. And another thing that was brought up several times is that Buffett said a few times at the meeting, I don't know what we did to grow this culture.
Yes, that's right. He did say that.
He said it so many times, but now we have it. And we know what to do to keep it. Because people have asked him, like, how did you grow this culture at Berkshire? And he actually doesn't know.
It just
kind of happened. But I think they grew it through integrity and honesty.
Of their own. And so honesty and integrity attracts that.
And you could see that. I mean, another question was about Greg Abel, and if there's a conflict of interest because he owns personally so many shares in the
Berkshire Hathaway Energy
worth, I think it was $500 million,
something like that. I think that's what the person said.
And Munger said, he's like, if that's a conflict of interest, because they have so much trust in Greg Abel's integrity, he said, if that's a conflict of interest, I want 20 more conflict of interest like
just
that.
Like that. That was telling. For sure.
So it was interesting. He said, oh, we don't know how we built this culture, and he kept saying, but the culture is why we have what we have. The culture is why. But I think they built it on honesty. And integrity. And I think that is why so many people don't have that, because a lot of businesses are not built on honesty and integrity.
Along that same vein, just even the culture in and of itself, just kind of going, this isn't a business thing per se, but even going to the meeting, you notice that everyone's treated the same.
Yes, that's true.
Everyone's treated the same. And one of the things they had mentioned is that a hedge fund who owns, I can't remember what percentage of Berkshire Hathaway B shares, I think he said 3% or something, of Berkshire Hathaway B shares, called Warren Buffett up or sent him an email requesting a special meeting. He said, well, why would I give you a special meeting? You're going to learn things at this exact same time as everyone else is. And so
he said he gave him one, I think, in the end.
He said he gave him one, as in that was it.
Oh,
that was the meeting. Was it? It was on Saturday, April 30th was the special meeting, and everyone else got to hear it too. Yeah. And so the funny thing is, actually, we didn't know this, but you could see some fairly famous investors there.
Well, we saw one, and you're like, I know that guy. I know I should know who that guy is, but I actually don't know who that guy is.
Yeah. And then I found out later. I won't say who it was, but there's actually some quite famous investors there.
Yeah.
That you can see.
Doesn't include, Tim Cook was on the floor, Bill Gates was on the floor.
Yeah.
Jamie Dimon was on the floor, but so they had kind of a special spot up in the front on the floor.
Yeah.
But there were very big investors just walking around,
hedge fund managers and things like that
the convention.
That most people would probably recognize their names. Were just walking around, and in the same seats as we all were.
Yeah.
So that's nice.
And that's again that culture.
Yeah.
Right. There's not nepotism. There's not favoritism. There's not. I don't know. It's a good culture.
Preferential treatment.
Yeah.
Yeah. So one of the other things that was a hot topic was obviously the topic of inflation. Mm-hmm. So there's a number of questions about inflation and the inflation environment, etc. And we talked a little bit about that earlier, where we spoke about how he doesn't make decisions based upon macroeconomics and things like that. And he said that in the past. But one of the things he said that really hit me was he said, nothing is the same the second time around in economics. Mm-hmm. So that was interesting. He said, because history affects behavior and behavior affects economics. Mm-hmm. So we have this high inflation environment and everyone's assuming it's going to go the same way. And I've assumed that it's going to go the exact same way as it did in the 70s and the 80s. Oh, we're going to end up with sky high interest rates and things like that. And the point being is, if you take that at face value, I think he's right, it might not, because it affects behavior. And when you appreciate something's going to come and some bad thing's going to happen, people are probably going to take pains to stave it away.
Right, because they've already learned that lesson.
They've
read about it in the textbooks. They've lived it. So they're like, okay, well, we didn't do this, or we did do that, so let's not do this, or let's do that. So they try to actually do things a little different, and in doing things a little different, it actually changes the outcome. Absolutely,
right? So, like if you are walking across the street and you trip on a curb, you're probably going to be watching for that curb again, and you're not going to trip on it a second time. And you might trip on the curb later down the road. Yeah. But the point being is that it affects behavior. Yeah. And behavior economics has its root in behavior and human behavior.
Very much so.
So end with a quote, actually. And so we mentioned that there was some famous investors there. And one of the investors who was there, it was Tom Gaynor. And he's the co-CEO of Markel Management. And he says this. He says, this is no different than it would have been 6 days ago, 6 months ago, 6 years ago. And he was speaking about Berkshire's latest stock purchases. It said he noted that the Berkshire's chief has been following the same investing process for more than 6 decades. And this is the quote. It says, it's like going to church on Sunday. I'm not expecting to learn something new. I learned something new, but he might not have learned anything new. He says, but he continues, it says, but it's good to be reminded of the basics and the things that matter. So the point being is, if you're interested in going to the Berkshire meeting, you may be a sophisticated investor, who knows, but I think everyone can take something from it.
Oh, let's see, we went through share buybacks. We went through their view on oil and their recent purchases. We talked about the simplicity of investing and how they view it. It doesn't take them long. I think they said 10 minutes. They could figure out what a company is worth or not. And they talked a little bit about inflation and the economy and how we don't know how this inflationary environment is going to turn out, because we have history to guide us, and that guiding of history actually will affect the future. Right. And I think those were kind of the biggest take home points. Biggest investing take home points. They talk a lot about other things, but we wanted to keep it to investing because that's what we're talking about. And so we'll end it there. But if you have found any value from this, please share it with others. Like and subscribe the video, comment if you want. And we look forward to bringing you guys more, hopefully valuable information next week.